In the next 10 minutes, we are going to quickly go through private equity valuation. So private equity investors generally invest in a private equity fund and then private equity fund invest in different companies. Uh, One of the idea here is getting favorable debt financing for small companies which private equity funds can do. So much of the debt financing for private equity funds come from syndicated loan market, but that is often replaced with collateralized loan obligation and collateralized debt obligation. So those things are a lot that comes from private equity. The control mechanism of private equity is compensation, drag along. Anytime an acquirer acquires control of a company, they must extend to all shareholders, including firm management. A board representation, the private equity firm is ensured control through board representation if portfolio major events such as takeover. Non-competing clause, company must agree to prevent the competing against the company with specified period. Priority in claims. Private company firm receive their before the owners, often preferred dividend and some multiple original investment. Required approach, required approvals. Change of strategy must be approved by private equity firms. Earnout that are used to predominant venture capital investment. The earnout acquisition is price paid over to portfolio company future performance. So this is different from buyout ratio, and there are a lot many different that have been pointed out. So low predictability versus high predictability, new market versus stable market, product based on established product. So buyout is where you would go and buy a public company and make it private. Here you are buying a small company and making it private. Private equity valuation method has discounted cash flow and relative value and market value approach. Price multiple, discounted cash flow are often used. Whereas the buyout valuation issues, there are leveraged buyout. The LBI model has three inputs: the target company's forecasted cash flow, expected return, total amount of financing. Since the company is private, public, although it's doing bad, it's easier. The exact valuation in buyout venture is nearly the same. So investment cost plus earning growth plus increase in multiple plus reduction in debt is equal to exit value. So payoff of multiple and IR for the equity investment holder. Then we have pre and post money valuation, and then we have a numerical about carried interest and hurdle rate and the distribution waterfall, and finally a big numerical that you have high chances of getting it there is performance measures. Let's start with calculating payoff with IRR for equity investor. Let's understand what does that mean. So if there is an LBO transaction, suppose it's valued 1 million, if occurs in 5 years at a projected multiple of 1.8, and company's multiple is 60% at 40% equity, preferred shares, equity, preferred share 14%, and so on. Calculate company for payoff claimants and internal rate of return and payoff multiple for equity domain. So let's first calculate the exit value. So most of the time the exit value is given as a multiple, like EV by EBITDA or some other multiple of equity or some kind of that multiple of company's initial cost. Once that is done, you have debt, preferred shares, private equity firm, and management. So you can find out who will get what, the total investment by private equity firm, the total payoff, uh, and then you can calculate present value of your internal rate of return as a private equity firm of what you are going to get uh, in between as well. So that's how you are going to look at. So there is a component of return which is return on preferred share on private equity, increase in multiple upon exit, reduction in debt claim. So those are the components of return for the entire entity. Then you have pre and post money valuation. Pre plus INV equal to post. So pre valuation, post money valuation, private firms makes an investment in early stages. So investment proportion of venture capital is INV upon post. So for example, a company is valued 3 million and a capital influx of 1 million by a VC takes place. So total becomes 4 million and the ownership of VC is 1 million. The appropriate method to venture capital valuation should consider a lot of things. Valuation issues are a little different in buyout versus venture capital. So there are DCF and use of debt, etc. are easier in buyout, tougher in venture capitalists because of its new companies. The exit routes are public offering, secondary market sale, management buyout, liquidation, and exit timing. Now let's look at the structures of private equity firm, the term valuation and things like that. So Limited partnership. The most common form of ownership for private equity fund is limited partnership. The limited partners provide funding and do not have active role in the management. Their liability is limited to what they have invested. The general partner in a limited partnership is liable for all firm's debt and has unlimited liability. GP is the manager of the fund. Another form of private equity fund structure is companies limited by share. It offers legal protection to participants. A private equity fund must raise a fund and manage investment of those funds. Private equity fund terms. So those are how the limited partner and general partner would work. Economic terms of private equity fund are management fee, transaction fee, carried interest, performance fee, ratchet. Ratchet specifies the allocation of equity between stockholder and management of the portfolio, or management to increase allocation depending on company's performance. Hurdle rate. This is the IR that the fund must meet before GP can receive a carried interest. It varies from 7 to 10%. Target fund size. The stated total maximum PF specifies the absolute figure. It signals the GP's ability to manage size of the PV. Vintage. This is the year fund was started, term end. So calculate carried interest with the hurdle rate. Suppose a fund has a committed capital of 100 million and carried interest of 20% and a hurdle rate of 9%. The firm called 80% of its commitment in year 1 and 50 million was invested in company A and 30 million was invested in company B. At the end of 2 years, $7 profit was realized from exit of company A. The investment in company B is unchanged. The carried interest is calculated on deal by deal basis. Example IR. So determine the theoretical and carried interest. So theoretically carried interest is 20% of 7 million, which is 1400. The IRR for the company is 6.8%. Because 6% is less than the hurdle rate. You cannot give the interest. So that is how you're going to look at that. So theoretically the carried interest is 20%. So carried interest or performance fee, this is GP's share of the fund and usually 20% of the profit after the management fee. So nothing would be given. So carried interest should be 20% of 70 million. No carried interest is given. This is to motivate them to perform good. Now they have a keyman clause, performance disclosure and confidentiality, clawback, distribution, waterfall, a tag along, drag along clause, no fault divorce, removal for clause, investment restriction and co-investment. Applying waterfall method. Let's look at that. Suppose a fund has a committed capital of 100 million and a carried interest of 20%. An investment of 40 million is made later on this year. The fund exits the investment and earns a profit of 22 million. Determine whether GP received any carried interest under the 3 distribution waterfall method. So in deal by deal basis, the carried interest should be the profit, 20% of the profit that you made. In total return method, what carried interest only after the value exceed the committed capital. So the value committed capital is 100 million and the exit are only 62 million, so no carried interest in paid. In method 2, carried interest can be paid when the value of portfolio exceed investment capital by a minimum of 20%. So invested capital plus 20% of the threshold. Let's look at this. This is a little tricky. So in method 2, the carried interest can be paid when the value of the portfolio exceed invested capital by a minimum amount of 20%. So 20% threshold was 48 million. This exceed this is more. You got 62 million because you made 22 million. So you just needed 8 and you made a lot. So the carried interest 4400 is paid to the GP. So 20% of this 22 million is paid to the GP. So if you get, you get whole. If you don't get, you get nothing. Continuing with the previous example, suppose in the second year another investment 24 expires in a loss of 24 assumed by deal when clawback with annual or true up apply. Determine whether GP must return any former profits. In deal by deal method, GP has received a carried interest of 4400 with a subsequent to follow. GP owns 20% of the loss. So 20% of loss is 800 million. Oh sorry, 800,000. So that's how it will return. Now net asset value, ways to determine asset value at cost, adjusting for subsequent financial devaluation at the minimum cost value, by revaluing portfolio at cost with no adjustment, using discount factors, less frequency issues in calculating NAV, due diligence of private fund, post investment expectation, general risk, cost of private equity funding. internal rate of return, gross IRR and net IRR, multiples, paid in capital, distribution to paid in capital, residual value to paid in capital, total value to paid in capital given on your screen on the third last point. So uh, those are the things. Let's look at a question to understand what these numbers mean. So they tell us that you have two funds A and B. You have gross IRR, net IRR, performance quartile, DPI, RVPI, TVPI and maturity of the fund. So let's look at what does this mean. So gross IRR, the IRR can be calculated gross or net of the fees. Gross IRR reflects fund's ability to return from the portfolio companies and is a relevant measure for cash flow. Net IRR can subsequently be different from gross IRR because it is net of management fee, carried interest and no compensation to GP. The net IRR is the relevant measure for cash flow between fund and LPs, therefore relevant return for LPs. Paid in capital, this is the capital utilized by the GP. It can be specified in percent terms. Distributed to paid in capital, this is LP's realized return in the cumulative distribution paid. So it is the net of management fee and carried interest. DP as referred to cash on cash return. Residual value to paid in capital, this measures LP realized return and is the value of LP's holding in fund divided by the cumulated investment. It is net of management fee and carried interest. Total value to paid in capital, it's a measure of LP realized and unrealized return is the sum of DVPI and RVPI. So those are the things. It is net of management. So residual and distributed sums are total. Let's look at the question now. They have fund A and B. You have given gross IRR, net IRR, DPI, RVPI and TVPI. Interpret and compare financial performance of funds A and B. So examining in DPI, fund A has distributed $1.43 in return for every dollar invested. RVPI implies that it will return 1.54 as other investments are harvested. Gross IRR 22.1% is attractive after the fees. Net IRR is 17.6. After 4 years, fund B is less mature than fund A. So the fund's DPI is 0.29, indicating that the realized return from fund are not substantial. Unrealized return are not harvested. The net IRR suggests that firm may not be affected by the J curve, where fund experience initial loss before expecting later profit. Currently firm is lagging to peer and is ranked in the third quartile. Let's look at the biggest question and the question that is most important for you, which is the question of how the money would flow from top to down, and this would help you understand the chart here. So I am going to that chart in the next video.